Hello, this is Mr. Chris, and welcome to my channel, MrChris Retirement Income, where I share with you my journey in generating steady, reliable retirement income using the no-loss method of the wheel strategy and investing in ultra-high yield funds from yieldmax. This video is the first video for the series in Mastering the Wheel Strategy, a simple guide to generating retirement income. If you think options trading is just gambling in disguise, you're not alone. I used to think that way too. But after a year of trading the wheel strategy and earning over $200,000 from a $300,000 retirement investment budget, I've realized something important. Trading options using the wheel strategy isn't gambling. This is a retirement income system when you treat it like a business. But first, a disclaimer. I'm not a financial advisor, and the content of this video and my channel are for entertainment and educational purposes only. Please conduct due diligence and research before investing. Now let's start with a myth. Many people, especially retirees, hear options trading and immediately picture casinos, risky bets, or get-rich-quick schemes. But that's not how professional traders operate. In fact, there is a strategy called the wheel strategy that is built on discipline, consistency, and income generation. The key difference is this: gambling is random and reckless, while the wheel strategy is structured and risk managed. Those are the two key things about the wheel strategy. It is a structured system and the risk is managed. Now, trading options using the wheel strategy requires you to be a seller of cash covered put options or covered call options. You earn premiums by selling option contracts, just like an insurance company is selling policy contracts to earn premiums. Now, why it is more like an insurance business? Think of it this way. When I sell options using the wheel strategy, I'm not placing a bet. I'm collecting a premium, just like an insurance company does. Insurance companies make money by collecting premiums over and over again, and they manage risk carefully so that most of the time they keep the money. That is exactly how I treat my options portfolio. I only enter trades I'm comfortable owning, and then I keep cash in reserve, and I follow a system that I can repeat month after month. Here are the main reasons why options trading is more like an insurance business. Number one, you collect a premium up front. Just like an insurance company collects a premium from policy holders, an option seller, also called a writer, collects a premium from the buyer of the option. This upfront payment is income for assuming a potential future risk. This is the reason why I always say that my earned premium is an income even though the option's expiration date is still in the future. In accounting terms, I am using a cash basis accounting method where I declare income or loss at the time I receive or lose cash. This means that if I get assigned a cash covered put options, I acquired an income generating asset at a discount. If I get assigned a covered call option with a strike price lower than my cost, then I have to declare a loss. If I get assigned a covered call with a strike price equal to my cost, then I basically sold my income generating asset at cost. Number two, you take on risk for a payout later. When you sell a put, you are promising to buy the underlying asset or stock at a set price if the buyer wants to sell it. This is like insuring the downside. If the stock drops below the strike price, you take the loss. When you sell a call, on the other hand, you are agreeing to sell the stock at a set price, which caps your upside and could lead to losses if the stock price goes way above the strike price. This is like insuring someone else's upside potential. Number three, most insurance policies and options contracts expire without a claim. Just like most insurance policies never result in a claim, most options expire worthless, especially short-term out-of-the-money options. The seller keeps the premium in both cases. Number 4, probability-based business. Both are probability-driven. Insurance companies use actuarial tables. Option sellers use implied volatility and probabilities like delta or probability of expiring in the money or out of the money. Number 5, catastrophic risk if mismanaged. If an insurance company underprices its risk or is over-leveraged, it can blow up when a disaster happens. Same for an option seller. Unhedged short options, especially naked calls or puts, can result in unlimited or very large losses. This is the reason why in the wheel strategy we only sell cash covered put options or a covered call options. Now this is the reason why we have to manage the risk when using the wheel strategy through proper pricing, diversification, and budget management. Now here is a real-world example. Warren Buffett's Berkshire Hathaway sells insurance and has also sold long-dated index put options. He once described them as similar, saying they took in premiums to underwrite risk, whether that risk was a hurricane or a market crash. Yes, option selling is fundamentally an insurance-like business, especially if you are doing it systematically for income. And like at any insurer, the key is proper risk pricing, diversification, and capital management. Now here's a table that shows a more comprehensive comparison of trading options using the wheel strategy and an insurance business. Now over the past year, I've used this strategy starting with a $300,000 budget account, and I have generated over $200,000 in real income. Now recently, I started increasing my budget to $500,000. The result of trading options and the dividends I received from my yieldmax portfolio have increased my total portfolio, and so it is time to start further growing the business. Hence the increase in my trading budget. That is not a miracle. That's what happens when you approach options trading as a business and not a gambling system. For retirees like me, the goal is not to get rich quick. My main objective is to generate a reliable retirement income. The goal is to build a reliable stream of monthly income so you can enjoy your time without constantly worrying about running out of money. And the wheel strategy, when done right, is a powerful tool to do just that. Now let's summarize. Trading option using the no-loss method of the wheel strategy is not gambling when treated as a business. Using the wheel strategy means that you are a seller of options contracts, similar to insurance companies selling policies. Trading options using the wheel strategy is not a get-rich-quick scheme, but rather a reliable stream of monthly income. Now here again is the table that shows the comparison between selling options and an insurance business. So if you want to generate your retirement income through trading options, use the wheel strategy and treat it as an insurance business where you act like an insurance underwriter. Thank you, and that's it. I will see you in the next video. If you like this video or any of the videos in my channel, please hit the like button and subscribe, and join me in my journey in generating my retirement income through trading options and investing in high-yield funds like yieldmax. If you have any comment or question about the no-loss method of the wheel strategy or my perspective about yieldmax, please write a comment and I will answer them the best I can. This is Mr. Chris. Thank you, and I will see you in my next video.